Welcome to Tech Money Madness, your daily U.S. stock market podcast, March 27, 2026. Today, in just a span of a few trading hours, something like $100 billion just vanished completely from the global luxury goods market.
Yeah, it's just staggering, just erased.
Erased, exactly, gone. And, that massive wipeout isn't just happening in a vacuum. It is the direct result of this market environment where an artificial intelligence boom, major geopolitical conflicts, and like these high-stakes domestic legal battles are all just crashing into each other at the exact same time.
Right. It really is a stunning amount of wealth destruction in a single sector. But, it perfectly illustrates what happens when the underlying mathematics of the global economy just suddenly change.
Oh, for sure.
We are looking at a landscape today that is basically forcing institutional investors and everyday retail traders alike to completely reevaluate all their fundamental assumptions about risk.
Which is exactly why we are here.
Yeah.
Right. We want to welcome you to this custom-tailored deep dive. We are taking today's comprehensive daily market briefing, and our mission is really to just look under the hood.
Yeah.
So, okay, let's unpack this.
Let's do it.
The Nasdaq just closed out its worst week in nearly a year. We are going to figure out the mechanisms driving that plunge, untangle the contradictions in the tech sector, and really extract the insights that you need to stay well-informed without feeling, totally overwhelmed by all the noise today.
Yeah, because treating this briefing as just a list of ticker symbols and percentages, it really misses the actual story. The financial data we're looking at today is essentially a real-time behavioral heat map. It shows us exactly how global fear, consumer exhaustion, and this rapid technological evolution are all colliding.
Absolutely. So let's start with the macro storm before we look at the individual trees, because, the numbers at the top of the briefing are honestly pretty grim.
Yeah, they are.
The Nasdaq Composite Index fell 3.5% this week. That is the worst weekly drop since April of 2025. The Dow Jones Industrial Average dropped 2.8%, and the S&P 500 declined by 3.1%.
Right.
It is a systemic, broad market sell-off. We're looking at a barometer basically screaming that there's some terrible global weather out there.
If we connect this to the bigger picture, the briefing really zeroes in on the primary catalyst for this systemic drop, which is the escalating geopolitical tensions. Specifically, the conflict involving Iran.
Right, the geopolitical heat.
Exactly. And the immediate consequence of that tension is this massive supply fear in the energy sector. It's driven oil prices to close at their highest levels since 2022.
Wait, I need you to walk me through that leap, because this is where market logic sometimes feels a bit disconnected from reality for a lot of people.
Sure.
Why does a software company in Silicon Valley, right, a company which builds code in the cloud, why do they lose a massive chunk of their valuation just because a barrel of crude oil in the Middle East suddenly costs more?
Well, that is the core mechanical question of a macro sell-off, really. It all comes down to the relationship between energy, inflation, and the Federal Reserve.
Okay.
Oil is the baseline input cost for the entire physical economy. When energy costs spike back to those 2022 levels, it suddenly costs significantly more to manufacture goods, transport products across the ocean, and critically for your example, power the massive energy-hungry data centers that the entire tech industry relies on.
Oh, wow. So everything gets more expensive to operate? The high price of oil acts almost like a high-pressure system, forcing everything else down.
Yes.
A tax on the entire supply chain.
A pervasive, unavoidable tax, exactly. And when that happens, inflation threatens to become really sticky. It stops going down.
Yeah.
If inflation stays high because of energy costs, the Federal Reserve is essentially forced to keep interest rates high just to cool the economy down. Now, bring that back to your Silicon Valley software company.
Okay, I'm with you.
The tech sector, which obviously dominates the Nasdaq, is largely valued on future growth. Investors are paying a premium today for cash flows they expect to see, 5 or 10 years from now.
I see. And if interest rates stay high, the math on those future cash flows changes.
Drastically. High interest rates act like gravity on future valuations. Wall Street uses a higher discount rate to calculate what that future money is worth today.
Right, because money's expensive to borrow right now.
Exactly. A dollar earned in 2030 is suddenly worth a lot less today. So 2022 level oil prices essentially force the market to reprice the entire growth trajectory of the tech sector downward.
Wow. Okay, but that pressure from 2022 level oil prices isn't just an abstract number on a screen for institutional investors, though. It's actively draining consumer wallets at the gas pump right now.
Oh, absolutely. It's highly visible to everyone.
Which brings us to a really fascinating contradiction in today's domestic data. The briefing highlights what looks like a surprising bright spot for the everyday consumer. Based on new filing data, the average IRS tax refund is actually up 10.9% this year.
Yeah, that is a highly notable data point in the briefing. Historically, a significant bump in tax refunds acts as a sort of micro-stimulus for the domestic economy.
Right.
Millions of households suddenly receive this cash injection, which often translates into, paying down credit card debt or making discretionary purchases like new appliances or home repairs. It provides a real buffer.
But I kind of want to challenge the actual weight of that buffer.
Okay, go for it.
We are looking at two competing forces here. On one side, consumers are getting a 10.9% bump on their IRS refund. But if the average refund is, say, around $3,000, a 10.9% bump is roughly an extra $300. On the other side, we have the inflationary pressure of 2022 level oil prices trickling down to daily life. Does an extra $300 in April actually give consumers enough liquidity to survive, paying $20 or $30 more at the pump every single week?
The math strongly suggests it does not. And that is precisely why the market remains so anxious right now. You are highlighting the exact difference between a one-time liquidity injection and a sustained liquidity drain.
Yeah.
The IRS refund might keep a household's engine from stalling this month, but the sustained cost of energy slowly bleeds out their discretionary spending capacity over the entire year.
And compounding that economic anxiety is a very noisy political backdrop happening domestically.
Very noisy.
The briefing notes that Senator Elizabeth Warren has leveled some sharp criticism at the Federal Reserve chairpick, Kevin Warsh, stating publicly that he has learned nothing from his past failures.
Right.
Concurrently, in the political tech space, the White House just launched an app touting President Trump's record, though the market briefing notes the app contains key omissions regarding his policy impacts. And just to pause here really quickly for you listening, we need to be very clear about something.
Yes, absolutely.
We are strictly and impartially just reporting the contents of the briefing for you today. We are not taking any sides or endorsing any of the viewpoints presented in this political coverage, left or right.
Exactly. Our job is just to analyze how the market digests this information purely objectively.
Right. So looking at this strictly from a market sentiment perspective, setting aside the actual politics entirely to look at how capital reacts, what does this all mean for the everyday consumer and investor?
Well, what the market sees here is fractured leadership and structural uncertainty. And the market fundamentally hates uncertainty more than it hates bad news.
Right. Bad news you can price in.
Exactly. When you have the leadership of the Federal Reserve being actively contested at the exact moment the market is terrified about inflation and interest rates, it removes any sense of a steady hand at the wheel.
Yeah, that makes sense.
Capital requires predictability to allocate risk efficiently. When political polarization bleeds into macroeconomic policy, that predictability just vanishes.
And that profound uncertainty brings us directly to the tech sector,
Mhm.
which is currently battling its own massive internal identity crisis. If consumer wallets and oil prices are dictating the broad market's downward momentum, the tech sector's internal chaos is being driven entirely by artificial intelligence. Here's where it gets really interesting, because the divergences in this briefing are staggering.
They really are. The volatility is completely decoupling companies that used to trade in lockstep with each other.
Let's look at the winners first. Micron Technology is listed as one of the day's top gainers. They're experiencing incredible earnings growth, fueled by a massive demand for the specific memory chips used in AI applications. They are literally selling the shovels for the AI gold rush. But then you look at the cybersecurity sector, and it's slumping heavily this year. The briefing cites fears that new AI models will completely disrupt their existing business models. Walk me through the mechanics of that disruption.
It's fascinating.
Why does AI threaten to break the cybersecurity industry? Like a sinkhole just opening up under their foundation.
It comes down to how traditional cybersecurity was fundamentally built. For decades, legacy cybersecurity companies operated largely on what's called signature-based detection.
Okay.
They maintained massive databases of known malware. When a file tried to enter your network, the security software checked to see if its code matched a known signature of a virus. If it did, it blocked it. It was essentially a highly sophisticated bouncer checking ideas against a list of known troublemakers.
But AI changes how the troublemakers operate, I'm assuming.
Dramatically, it automates the creation of new troublemakers instantly. Generative AI allows bad actors to create what is known as polymorphic malware. Yeah, it's malicious code that constantly rewrites and changes its own structure every time it deploys. It doesn't have a known signature. Furthermore, AI can instantly analyze a company's specific network defenses and custom generate a zero-day exploit designed specifically to bypass them.
Oh, wow. So the defense industry has to completely rebuild from scratch. They can't rely on the old databases anymore, which means their existing products are suddenly approaching obsolescence.
Exactly. Which forces institutional investors to violently reprice those cybersecurity stocks. It is a paradigm shift. If the offense suddenly has an automated factory producing custom weapons, the old shields are mathematically worthless.
That makes the inclusion of Nvidia in this briefing incredibly fascinating. I read this part of the report 3 times because it presents a total contradiction.
Yeah, I saw that too.
Nvidia is listed in the market movers section as a top loser for the week, sitting right alongside Tesla and Meta. But in the very same report, in the notable tech moves section, the text notes that Nvidia's stock price actually rose despite concerns over its exposure to the AI memory shortage.
Right.
How does a stock rise but still get categorized as a top loser?
It is a brilliant illustration of how complex market mechanics are right now. What you are seeing is the tension between a localized micro event and a massive macro trend.
Okay, unpack that.
Over the course of the 5-day trading week, Nvidia suffered enough of a systemic sell-off, dragged down by that 3.5% drop in the broad Nasdaq we discussed earlier, to land mathematically on the week's top losers list.
It's like a remarkably strong swimmer caught in a riptide.
That's a great way to put it.
Over the course of the week, the riptide, the macro sell-off caused by the Iran conflict and oil prices, pulled them way down the beach. So for the week, they lost ground. But on any given individual day, their underlying strength allowed them to successfully swim forward against the current.
That is the perfect analogy. And the reason they swam forward on that specific day is that the market realizes the structural demand for AI processing power isn't vanishing, even if there are short-term supply chain hiccups regarding those memory chips.
Right.
Investors still view Nvidia as the foundational engine of this entire technological shift.
But not every tech giant is fighting an AI battle right now. Meta fell heavily this week, and the briefing points out it wasn't about chips or data center costs. Meta was hit by twin legal defeats and ongoing severe concerns over its handling of user data.
Which serves as a really stark reminder to investors that traditional corporate vulnerabilities haven't disappeared just because AI is dominating all the headlines.
Definitely.
Regulatory crackdowns, antitrust suits, and data privacy litigation carry massive financial penalties. Those can erase billions in market capitalization overnight, completely regardless of a company's AI capabilities.
And amidst all this turbulence, the most active stocks by volume are the absolute titans: Apple, Microsoft, and Amazon. The volume is churning because institutional investors are desperately trying to rebalance their massive portfolios around this AI disruption and the high-pressure system of oil prices.
Right, which naturally pushes capital to look for returns outside of the tech sector entirely. When the primary growth engine of the market begins to stall or become unpredictable, capital flows into other industries, looking for either defensive stability or mispriced opportunities.
And that brings us full circle to the unlikely winners and the luxury losers we mentioned at the start of the show. Because while tech struggles with its identity crisis, other industries are experiencing wild swings tied directly back to those global factors.
Yeah.
Let's return to that staggering number. $100 billion wiped out from luxury stocks due to the Iran conflict.
What's fascinating here is how it perfectly illustrates how highly sensitive discretionary spending is to global stability. The luxury goods market is almost entirely reliant on consumer psychology.
An aura of wealth.
Exactly. Economic confidence and the free flow of international travel. When geopolitical conflict escalates in a major oil-producing region, that psychological confidence simply evaporates.
I want to push back on the singular blame being placed on the Iran conflict, though.
Oh.
Is a $100 billion crash purely the direct result of a geopolitical headline? Or is the conflict just the sudden catalyst, like the match that was dropped into a forest of underlying consumer exhaustion?
That's a very fair question.
We just talked about oil prices squeezing wallets and a tax refund that isn't large enough to cover the gap.
Yeah.
Weren't consumers already tapped out before this specific escalation?
You are hitting on the exact thesis many economists are currently arguing. You cannot cleanly separate the geopolitical conflict from the mathematical reality of inflation. They are deeply intertwined.
Right.
The conflict creates the acute headline fear, but the sustained high energy costs create the structural exhaustion.
So even high net worth individual, the target demographic for these luxury brands,
Hmm.
they look at their portfolios drop in the S&P 500, they see the cost of energy soaring across their businesses, and they decide to delay buying a $10,000 watch.
Precisely. The elasticity of demand for a luxury watch is incredibly high. It is the ultimate non-necessity. When the cost of maintaining a baseline lifestyle rises across the board, the easiest and fastest way for any household, even a wealthy one, to preserve liquidity is to instantly halt luxury discretionary spending.
Wow.
That $100 billion wipeout is the market aggressively pricing in that behavioral shift.
But while luxury is bleeding out, the healthcare and pharmaceutical sector produced a massive surprise.
Mm.
AstraZeneca emerged as a top gainer this week, following a surprise trial win for a new lung disease drug. It sent their stocks soaring against the entire current of the market.
It is the perfect counter-narrative to the broader doom and gloom. It proves that a tangible scientific breakthrough, a mathematical solution to a human illness, can still defy broader market gravity.
Wall Street uses specific terms for this dynamic, right?
Right.
It's a great reminder that even when the overall market tide is going out, what the industry calls beta, a specific company can still swim against the current using its own motor, generating true alpha based on its own merits.
Yes, beautifully said. Beta represents the systemic risk. It's the riptide pulling the Nasdaq down 3.5%. Alpha is the value a company creates independently of that tide. AstraZeneca's drug trial win is pure alpha. It doesn't matter what oil prices are doing. If you cure a disease, the market will reward the value of that intellectual property.
And just to round out the bizarre nature of today's market movers, Sony also made the list of the day's top gainers. It seems entertainment and electronics still hold their own unique defensive positions when things get volatile.
Entertainment historically acts as an escapist defensive play during times of geopolitical or economic stress. When people cut back on travel or luxury goods, they tend to substitute those large expenses with smaller at-home entertainment options.
Oh, that makes total sense.
Yeah, it's a fascinating, historically consistent psychological quirk of the consumer market.
So let's pull all of these disparate threads together and synthesize what we've learned from today's briefing. We started with a barometer reading a massive macro storm, and we've seen exactly how its pressure changes the landscape below.
We tracked three major collisions today. First, the geopolitical tensions, primarily the Iran conflict, which is driving oil prices to 2022 highs.
Right.
That energy spike acts as a pervasive tax on the supply chain, forcing the Fed into a corner, discounting tech valuations, and directly triggering that massive $100 billion wipeout in consumer luxury goods.
Second, we unpacked the immense structural volatility in the tech sector. The AI boom is rewriting the rules of the economy in real time. It's creating explosive hardware growth for suppliers like Micron, while simultaneously rendering legacy software models like traditional signature-based cybersecurity mathematically obsolete.
Yeah.
And we saw how that creates wild contradictions, like Nvidia swimming forward daily while being pulled backward weekly by the macro riptide.
And third, we observed how distinct corporate narratives can completely decouple from systemic trends. Companies weighed down by traditional legal and regulatory risks like Meta are being brutally punished, while companies that deliver undeniable, isolated results like AstraZeneca's drug trial win are heavily rewarded with pure alpha.
It is a market that demands you look past the daily ticker symbols to understand the underlying mechanisms, the why behind the movement. Which brings us back to where we started. If this market environment is a machine throwing gears across the room, we have to wonder what hidden mechanism is going to snap next.
Absolutely.
So I want to leave you with a lingering question to ponder as you look at the headlines this week. Think about the mechanics of the AI disruption we discussed. If generative AI can automate the creation of polymorphic code so effectively that it instantly threatens the foundation of a multi-billion-dollar cybersecurity industry, what other invisible structural pillars of the modern economy are completely vulnerable?
It's a sobering thought.
Consider your own industry, your own daily workflows. Where does your field rely on signature-based thinking, doing things a certain way just because that's how it has always been done? Because if there is one thing today's market briefing proves, it's that when the underlying mathematics of a system change, the ground shifts beneath us significantly faster than the indices can even track. That's all for today's deep dive of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.